The analysts we polled think they're pretty split on that point. 45% actually think that interest rates should be unchanged, while 44% think that we might see a 25 basis point hike in the interest rate. Financial derivatives, who think that we should see interest rates unchanged, point to the fact that the central bank would probably play up the fact that they need additional time and to better measure the impact of the tightening that we've seen since September last year, while analysts at Renaissance Capital are of the view that the central bank would support its move to raise rates by about 25 basis points by citing rising inflation expectations and an improving credit environment. As you know, the interest rate was kept on hold during the last MPC meeting in November after it was hiked in September. However, there are some that think that we shouldn't be hiking rates at all. Economic associates point to the fact that they think that the CBN should actually be cutting rates because the data that they've released concerning money supply and so forth do not point to the fact that there is any need for tightening. We also asked, do analysts anticipate any change in the CBN's exchange rate policy? And they were pretty unanimous on that point. They're of the view that we won't see any change, and the policy there, just to clarify, is that the central bank is looking to keep the naira-dollar exchange rate at 150 naira to the dollar, plus or minus 3%. We also polled on what analysts think should be the focus of monetary policy going forward. And they were pretty split on this as well. Inflation management was cited by 40% of those polled, private sector credit creation by 40%, and exchange rate management by 20%. And Standard Bank, which indicated private sector credit as what they think should be the focus, point to the fact that there's very little the MPC can do to rein in inflation because it is mainly driven by exogenous forces like bad weather and imported inflation. These are things that the central bank really cannot control by monetary policy. However, they feel a good point to note supporting that view is the fact that there has been a contraction in private sector credit month on month and indeed year on year from December 2010 from the data released by the central bank. Citi, on the other hand, point to the fact that they think the exchange rate should be the focus because FX reserve has been under pressure and the naira remains vulnerable to further weakness. We also polled on where the monetary policy should be, i.e., should it be tightening or should we be seeing easing at this point? And here, the overwhelming majority pointed to the fact that they think we should tighten. 67% of those polled say that we should be tightening in line with what the central bank is doing. And others think, 22% think that we should actually maintain the status quo, while 11% think that we should actually be easing monetary policy. Standard Chartered banks, the analysts we spoke to there indicated that there's a need to compensate for the government's fiscal should I say irresponsibility, as some have put it, because that has been one major issue that analysts have continued to play up in 2010, saying that the government has been way too aggressive in putting money into the system. And we also polled on what analysts felt was the greatest source of inflationary pressure going forward. And on that point, 42% point to rising global food and commodity prices. This, like I mentioned, some have indicated exogenous factors. These are some of the factors that they think might put some pressure on inflation going forward. Others point to government fiscal irresponsibility and, of course, a likely minimum wage increase, which has been, which analysts expect to really impact on the financial markets this year. While 17% point to deregulation of petroleum prices, while 8% point to bad weather as being something that might in fact impact on harvest and, of course, food prices. And then another 8% feel they don't see really any real risk going forward. Vertiva Capital Management, on their point about the deregulation of petroleum prices, say that any hike we see on that front is definitely going to be inflationary whenever it's implemented. And lastly, we asked a question about downside risks to the exchange rates. Do analysts think it's moderate or do they think it's low? On this point, 67% point to the fact that they think it's moderate, while 33% think it's low. And ARM were on the moderate side. They feel like there's a moderate downside risk because of risk aversion and possible capital flight ahead of the election. Obviously, some investors might be jittery ahead of those April elections. And finally, CSL stockbrokers think that the risk is low there because they expect that the oil price should hold up somewhere around where it is currently in 2011, and they don't think that the FX reserves are likely to fall to a danger point. Well, that is a wrap on the MPC expectations from the analysts that we polled. On that note, it's back to you, Eleni.
Would you allow me to poll you now, Wole? Where do you think we stand on the interest rate front?
Well, you know, I think that we probably would see rates on hold because for the points that many of these analysts have put forward, that the factors that have pushed inflation ahead most of last year were exogenous forces. And must also bear in mind that inflation has also come down over the last 4 months to about 11.8%. So I think the pressure is much less there, and I think that they will probably keep interest rates on hold. What will be interesting, though, will be on the exchange rate policy. We have seen some pressure on the naira, but good enough, it has stayed within that band. I think that the focus of the central bank will be to keep it within that band.
Well, Wole, I'll hold you to it there.